As you've said before, life continues to be tough for your home credit customers. So what's been your approach?
Well, we've had a very cautious approach to lending now for the last 3 years, and that's meant focusing very much on collecting well and on repeat business and dialing back a little bit on new business. We've dialed back a little bit more during 2011, so that we're now turning away about 4 out of 5 applications. Inflation's really been the key issue for our customers in terms of the food bill and the energy bills rising. And so customers' disposable incomes have been under some pressure, and we've responded to that by very much focusing on collecting well and on repeat business. We've also made a few changes to the way we pay our agents, and those have also had a beneficial effect on our collections performance.
From what we read, it sounds as if inflation is finally beginning to fall, and surely your customers must be seeing some benefit from that.
Well, I think it's right to say that there is a slowdown in the rate of inflation, which is good news. So you have to remember we're talking here about a moderation in the rate of increase of household bills rather than those bills starting to fall. Now, even though perhaps some energy bills have started to fall a little bit, they're still a lot higher than they were in 2009. I think it's fair to say that some commodities, particularly food and petrol and diesel, are still rising. The thing to remember about inflation is that it's really a dampener on growth. It means that loan ticket sizes can't rise because repayments need to remain affordable, and it also tends to dent consumer confidence. Now, as inflation starts to moderate and customers' incomes start to recover, we'd expect that confidence to come back and demand for home credit to pick up.
You reported an improvement in impairments in your home credit business, which is in stark contrast to most other lenders. Why is that?
Well, the home credit business has some very strong qualities in terms of impairments. Firstly, the loan ticket sizes are pretty small. Secondly, the duration of the loan book is very short, so we're only looking at a window of exposure somewhere between 6 and 12 months. Thirdly, we have very, very high levels of knowledge of our customers. We call on every customer every week to collect repayments. Most of our business is repeat business. And finally, we pay our agents on what they collect, not on what they lend. So those are huge strengths and make us look quite different to most other lending businesses. And then obviously overlaid on top of that, you've had the very cautious approach to lending that we've had over the last 3 years. And it's the combination of those things that have allowed us to deliver the impairment performance that we did.
Although you saw growth in home credit receivables, customer numbers nevertheless fell by 2% during 2011. So what are you doing to get the growth back?
Well, customer numbers did fall by 2% last year, and that was primarily because we chose to tighten underwriting on new customers. That resulted in around 80,000 additional customers being turned away versus what we would have done in 2010. That represents the difference between 2% growth in customers and the 2% contraction that we actually saw. It's important to say there's no shortage of demand from customers. There's plenty of people applying, but we're turning down now about 4 out of 5 of those applications. Also, there are some initiatives that we have running this year in order to get a little bit more growth into the business.
So what are those initiatives?
Well, firstly, we've been having a good look at the agency force, and what we've been doing is consolidating some of those smaller rounds into larger agencies which tend to be more profitable and more sustainable. So the number of agents the company has fallen to around 10,500, but those agencies represent more capacity and more working hours available, and they tend to be more profitable and more sustainable, and experienced, motivated agents who work for us full-time tend to produce very, very good results. The second thing we're doing is we're having a very good look at the footprint of the business across the UK. Now, as you know, we work out of branch locations, and we've identified some secondary towns where we don't currently have a branch, and those towns are managed from a nearby larger town as a satellite. And what we did last year was we opened new branches in around half a dozen of those towns with a view to getting some more growth, and we'll probably do some more of those new branch openings during 2012.